The stock market is supposed to be a machine that prices risk. Companies with strong fundamentals and real growth prospects should see their stock prices rise. Companies with weak balance sheets, declining revenues, or unsustainable business models should see their stock prices fall. That's how capital allocation is supposed to work. The market rewards good decisions and punishes bad ones. But that machine is broken. Not broken in the sense of crashed or collapsed. Broken in the sense that it no longer does what it's supposed to do. Stock prices increasingly have nothing to do with fundamentals, risk, or long-term value. They are driven by flows, momentum, leverage, and hype. The market still moves. Numbers still change. But the signals are distorted, and the system is fragile in ways most investors don't understand. This is the Money Timeline. Today, we're going to examine how the stock market became broken. We'll look at the rise of passive investing and how trillions in capital now flow without analysis, how concentration risk has made diversification an illusion, why hype stocks trade on narratives instead of business reality, how leverage has reached dangerous levels, and what happens when this fragile system finally cracks. This isn't a conspiracy theory. This is the structure of modern markets, and it's creating risks that most people don't see until it's too late. The stock market used to be dominated by active investors, fund managers, analysts, and individual investors who researched companies, analyzed financial statements, assessed competitive positioning, and made buy or sell decisions based on whether they believed a stock was overvalued or undervalued relative to fundamentals. This process, repeated millions of times across the market, was supposed to create efficient pricing. If a company was overvalued, active investors would sell or short it, pushing the price down. If it was undervalued, they would buy, pushing the price up. That system depended on active analysis and discretionary capital allocation. But over the last 2 decades, that system has been replaced by something fundamentally different. Passive investing. Passive investing means buying an index and holding it regardless of the fundamentals of individual companies within that index. Instead of analyzing whether Apple or Microsoft or Tesla is overvalued, passive investors simply buy all of them in proportion to their weight in the index. If a company is large, passive funds buy more of it. If it's small, they buy less. The decision has nothing to do with profitability, growth prospects, or risk. It is purely mechanical. The numbers are staggering. As of 2026, passive funds account for the majority of flows into U.S. equity funds. Trillions of dollars are managed by firms like BlackRock, Vanguard, and State Street, the 3 largest asset managers in the world. These firms collectively control a massive share of global equity ownership. They don't analyze companies. They don't make judgments about value. They buy index weights and hold. The appeal of passive investing is clear. Lower fees, simplicity, the argument that most active managers underperform the index anyway. So why pay higher fees for worse results? For individual investors, this makes sense. But when passive investing dominates the market, something breaks. The problem is that passive funds are price takers, not price makers. They do not correct misspricings. They do not sell overvalued stocks or buy undervalued ones. They buy whatever the index tells them to buy, regardless of price. This means the more passive capital there is, the less price discovery happens. Price discovery is the process by which markets determine the correct value of an asset based on available information. It requires active participants who analyze, disagree, and trade based on differing views of value. But if the majority of capital flows are passive, there are fewer active participants left to perform that function. The market still moves, but it moves for different reasons. Momentum, flows, index rebalancing, not fundamentals. This creates a paradox. The efficient market hypothesis, the theory that markets efficiently price information, assumes that informed investors are constantly analyzing and correcting mispricings. But passive investing depends on the existence of efficient pricing created by active investors. As passive investing grows, it undermines the very mechanism it relies on. In practical terms, this means stocks can become overvalued or undervalued, not because of hidden information or irrational behavior, but simply because there are fewer marginal buyers or sellers reacting to fundamentals. Prices drift, valuations stretch, and the market becomes more vulnerable to sudden corrections when passive flows reverse. One of the core principles of investing is diversification. Don't put all your eggs in one basket. Spread your capital across many companies, sectors, and geographies to reduce risk. Index funds are marketed as the ultimate diversification tool. Buy the S&P 500 and you own 500 companies. Buy a total market index and you own thousands. Diversification achieved. Except it's an illusion. Modern indices are more concentrated than at any point in recent history. As of 2026, the top 10 companies in the S&P 500 account for roughly 35% of the index's total market capitalization. The top 5, Apple, Microsoft, Alphabet, Amazon, and Nvidia, represent over 25%. When investors buy the S&P 500, they are not buying 500 equally weighted companies. They are buying a handful of mega cap stocks with a long tail of smaller holdings. This concentration has been driven by the dominance of technology companies and the feedback loop created by passive investing. As these companies grow, their index weight increases. As their index weight increases, passive funds automatically buy more. This pushes their stock prices higher, which increases their market cap, which increases their index weight further. It's a self-reinforcing cycle that has nothing to do with whether these companies are actually worth their valuations. The risk is that what looks like diversification is actually concentrated exposure to a small number of stocks. If those stocks fall, the entire index falls. If there is a sector-wide repricing in technology, passive investors cannot avoid it. They own the index, and the index is dominated by tech. This also creates systemic fragility. In a truly diversified portfolio, the failure or repricing of one company has limited impact on the whole. But when a small number of companies dominate, their movements drive the entire market. If Apple's stock falls 20%, the S&P 500 falls. If Nvidia reprices, passive investors holding total market funds take the hit regardless of whether they believe Nvidia is overvalued. The concentration problem extends beyond individual stocks to geographic exposure. U.S. stocks dominate global developed market indices. As of 2026, the U.S. represents roughly 60% of the MSCI World Index, far above its share of global GDP. Investors seeking international diversification by buying global index funds are actually making a concentrated bet on the U.S. market. This geographic concentration compounds the risk. If U.S. markets face a structural repricing due to valuation compression, earnings disappointments, or tightening financial conditions, global index investors cannot escape. Their diversified portfolio is in reality a concentrated exposure to U.S. megacaps. The feedback loop between passive flows and concentration creates a dangerous dynamic. As long as flows continue into passive funds, the largest stocks keep rising, their index weight keeps growing, and the concentration keeps increasing. But if flows reverse, either due to a market correction, a shift in investor sentiment, or forced liquidations, the same mechanism works in reverse. Passive funds must sell index weight, which means selling the largest stocks, which drives those stocks down, which triggers more selling. Concentration amplifies both the upside and the downside. Stock prices are supposed to reflect the present value of future cash flows. Valuation models, discounted cash flow analysis, earnings multiples, these tools exist to estimate what a company is actually worth based on its ability to generate profit. But in the modern market, an increasing number of high-profile stocks trade not on fundamentals, but on narrative, momentum, and hype. Tesla is the most prominent example. As of 2026, Tesla trades at a valuation that implies it will dominate not just the automotive industry, but energy storage, robotics, artificial intelligence, and autonomous vehicles. The company's market capitalization exceeds the combined value of the next 10 largest automakers despite producing a fraction of their vehicle volume. Earnings are volatile. Deliveries fluctuate. Competition is intensifying. And yet the stock price remains elevated, supported by a narrative of future dominance and a loyal investor base that treats criticism as heresy. The valuation disconnect is staggering. Traditional automakers trade at single-digit price-to-earnings ratios. Tesla trades at multiples several times higher. This is not because Tesla's current profitability justifies the premium. It is because the market prices Tesla as a technology company on the verge of exponential growth, not as a car company competing in a mature, capital-intensive industry. This creates a problem. If Tesla's stock price is driven by narrative rather than fundamentals, it becomes untethered from business reality. The company can miss delivery targets, face regulatory scrutiny, or see margins compress. And the stock can still rise if the narrative holds. But when the narrative breaks, when investors begin to question whether the promises will materialize, the repricing can be violent and fast. Tesla is not alone. The meme stock era of 2021 created a cohort of companies whose stock prices have little relationship to their business performance. GameStop, a struggling video game retailer, saw its stock price surge to levels that implied a business transformation that never materialized. AMC, a movie theater chain facing structural decline, became a social media rallying point with a stock price disconnected from its balance sheet reality. These stocks trade on momentum, social media sentiment, and coordinated buying by retail investors. Fundamentals, profitability, competitive positioning, none of it matters when the hype cycle is active. And when it fades, the stocks collapse. But the damage is not limited to those who bought at the peak. Hype stocks distort capital allocation, create false signals about investor demand, and contribute to the broader fragility of the market. The existence of hype stocks also reveals a deeper problem. If a significant portion of market capitalization is driven by narrative and momentum rather than fundamentals, the market is not pricing risk correctly. Investors buying index funds that include these stocks are not diversifying. They are taking concentrated bets on stories that may or may not play out. And when those stories break, passive investors have no mechanism to exit before the repricing happens. Leverage is everywhere in modern markets. Individual investors borrow on margin to amplify returns. Corporations take on debt to finance buybacks and acquisitions. Financial institutions use leverage to enhance profits. Leverage works brilliantly during stable periods. It magnifies gains. But it also magnifies losses. And when leverage is widespread, it creates systemic risk. Margin debt, the amount individuals borrow to buy stocks, has reached record highs. As of 2026, margin debt levels exceed those seen before the 2000 dot-com crash and the 2008 financial crisis. This means investors are more leveraged than at any point in recent history. As long as stock prices rise, this works. But if prices fall, leveraged investors face margin calls. They are forced to sell, which pushes prices lower, which triggers more margin calls. It's a self-reinforcing downward spiral. Corporate leverage is even more concerning. Non-financial corporate debt in the United States is at historical peaks relative to GDP. Companies have borrowed aggressively, taking advantage of years of low interest rates. Much of this debt has been used not for productive investment, expanding capacity, developing new products, but for financial engineering. Share buybacks are the most common form of this engineering. Companies borrow money to buy back their own stock, reducing the number of shares outstanding and boosting earnings per share. This makes the stock more attractive to passive index funds, which increases demand, which pushes the price higher. The company's fundamentals haven't improved. Revenue hasn't grown. Profitability hasn't increased. But the stock price rises anyway because the financial structure changed. This creates an illusion of value creation. Earnings per share go up. Stock prices go up. Executives whose compensation is tied to stock performance benefit. But the company is now more leveraged, more vulnerable to economic downturns, and less able to weather financial stress. The risk is asymmetry. Leverage amplifies returns during good times, but it amplifies losses during bad times. Because corporate leverage is concentrated in large, index-heavy firms, the risk is not isolated. It's systemic. If economic conditions tighten, if interest rates rise further, or if earnings disappoint, leveraged companies face pressure to deleverage. That means cutting costs, reducing buybacks, or in extreme cases, restructuring debt. All of this puts downward pressure on stock prices, which affects index performance, which triggers passive outflows, which accelerates the decline. Financial institutions also carry significant leverage. Banks, hedge funds, and asset managers use borrowed capital to enhance returns. This works until it doesn't. When volatility spikes or liquidity dries up, leverage positions unwind rapidly. The 2008 financial crisis was fundamentally a leverage crisis. Institutions borrowed too much, and when asset prices fell, they faced cascading margin calls and forced liquidations. The structure of modern markets has not eliminated this risk. It has just redistributed it. The combination of margin debt, corporate leverage, and financial institution leverage creates a system that is fragile by design. Small shocks can propagate quickly. Corrections become crashes. Volatility becomes contagion. And because passive investing has concentrated capital in the largest, most leveraged companies, the entire market is exposed. The broken stock market works fine during stable periods. Passive flows continue. Prices rise. Leverage amplifies gains. Hype stocks rally. But the system is structurally fragile. It depends on continuous inflows, stable sentiment, and low volatility. When any of those conditions change, the machine breaks. The trigger could be anything: a recession, a sharp rise in interest rates, a geopolitical shock, a major earnings disappointment from a mega cap stock. The specific catalyst matters less than the structure of the market. Once the process begins, the mechanics are predictable. First, passive flows reverse. During a market downturn, investors redeem their index fund holdings. Passive funds do not have discretion, they must sell. And because they hold index weights, they sell the largest stocks first. This creates selling pressure on the very companies that dominate the index. Apple, Microsoft, Nvidia, the stocks that drove the index higher now drive it lower. Second, leverage unwinds. Investors on margin face calls. They must sell to meet margin requirements. Corporations with high debt levels face pressure to deleverage. They cut buybacks, reducing demand for their own stock. Financial institutions reduce risk exposure, selling positions to meet capital requirements. All of this creates more selling pressure. Third, concentration amplifies the move. Because the index is dominated by a small number of stocks, their decline drives the entire market. Passive investors cannot escape. They hold the index, and the index is falling. Diversification, the supposed benefit of passive investing, provides no protection because the portfolio is not actually diversified. It's concentrated in the stocks that are falling the most. Fourth, hype stocks collapse. When sentiment shifts, narrative-driven stocks lose their support. Tesla, meme stocks, any company trading on hype rather than fundamentals faces rapid repricing. Retail investors who bought into the story sell. Institutional investors who held for momentum exit. The stock falls not gradually, but in sharp, violent moves. Fifth, volatility spikes. Passive selling creates indiscriminate pressure. Stocks fall regardless of fundamentals. This triggers algorithmic trading systems, which amplify volatility. Market circuit breakers may engage, but they only delay the adjustment. The repricing continues until valuations reflect a new reality, one shaped by reduced flows, lower leverage, and diminished confidence. The outcome is not a gradual correction. It is a rapid, system-wide repricing. And because the structure of the market has concentrated risk, hidden leverage, and distorted signals, the magnitude of the move is larger than traditional models predict. This is not hypothetical. The market has experienced versions of this dynamic before. The 2000 dot-com crash, the 2008 financial crisis. Each time the market recovered, but each time the structure became more fragile. More passive capital, more concentration, more leverage. The next time it breaks, the correction will be faster and more severe because the underlying structure is weaker. The stock market is not supposed to work like this. It is supposed to allocate capital efficiently, reward productive investment, and price risk accurately. But the rise of passive investing, The concentration of capital in a small number of mega-cap stocks, the prevalence of hype-driven valuations, and the buildup of leverage have created a system that does none of those things. Prices are determined by flows, not fundamentals. Risk is hidden, not priced. Diversification is an illusion. And the entire structure depends on conditions remaining stable. As long as passive inflows continue, as long as interest rates stay manageable, as long as sentiment remains positive, the system functions. But it is fragile by design. The market still moves, stocks still rise and fall, investors still make money, but the machine that is supposed to price risk and allocate capital efficiently is broken. And when the conditions that keep it functioning change, the repricing will be swift, severe, and systemic. The lesson here isn't that you should or shouldn't invest in index funds. This video explores a theory. Based on our analysis, it looks like the core essence of the efficient market hypothesis is partially broken. Remember, do your own research before making any investment decisions. This video is not financial advice. Thanks for watching the Money Timeline.